Most investing videos start with someone who already has 5 Indian rupees Lakh, 10 Indian rupees Lakh, sometimes crores to work with. Then they act surprised when a beginner with 10,000 Indian rupees watches that video and has no idea where to even begin. Here's the truth nobody says clearly enough: the exact same principles that manage a crore-sized portfolio apply to a 10,000 Indian rupees one. The ratios matter more than the raw number. If you understand how to split 10,000 Indian rupees correctly, you already understand how to split 10 Indian rupees Lakh correctly too. The math scales, the discipline doesn't change. So today, we're doing something most channels won't: a real, live breakdown of exactly 10,000 Indian rupees, split using a simple framework, so you can see the actual numbers, not just the theory. Why this matters right now? More first-time investors are entering markets younger than ever before. Fractional investing, low minimums, and apps that let you invest with just a few hundred rupees have removed the old excuse of, "I don't have enough money to start." But removing the money barrier didn't remove the confusion barrier. Most beginners with a small amount either go too safe and never learn anything, or go too aggressive into a single hyped coin or stock, and lose confidence, and often money, before they ever build a real habit. A simple, repeatable structure fixes both problems at once. That's exactly what we're building today. The framework, the 50-30-20 rule. This isn't a rigid law from a finance textbook. It's a practical structure many disciplined investors use, adapted here specifically for someone starting small, across both stocks and crypto. 50% stability layer. Half your capital goes into the safest, most established assets available to you, large cap stocks or index funds, and Bitcoin, if you're including crypto at all. These are assets with the longest track records, the deepest liquidity, and historically, the least extreme volatility relative to everything else in their category. 30% growth layer. The next portion goes into higher growth, higher risk assets, mid-cap stocks, or established altcoins with real usage and track records, not brand new, unproven tokens. This layer is where you accept more volatility in exchange for higher potential upside, without going into pure speculation. 20% opportunity and safety layer. The final portion stays in cash, or a cash equivalent like a liquid fund. This isn't wasted money sitting idle, it's dry powder. It lets you buy during a dip without panic selling something else, and it acts as a buffer so a market downturn doesn't force you to sell your other holdings at the worst possible time. Live breakdown, 10,000 Indian rupees, step by step. Let's actually put numbers on this, live, right now. 5,000 Indian rupees, the stability layer. You could split this further, say, 3,000 Indian rupees into a broad index fund or large cap stock, and 2,000 Indian rupees into Bitcoin, if you want crypto exposure. This half of your portfolio is designed to survive a bad year without wiping you out. 3,000 Indian rupees, the growth layer. Here, you might put 2,000 Indian rupees into a couple of solid mid-cap stocks, companies with real revenue and a genuine growth story, not just hype, and 1,000 Indian rupees into one or two established altcoins with real, ongoing development and usage. This is where you're deliberately taking on more risk, but in a controlled, limited way. 2,000 Indian rupees, cash reserve. Keep this in a liquid fund or simply set aside. If the market drops 15 to 20% in the next few months, which happens more often than beginners expect, this is what lets you buy more at lower prices, instead of watching from the sidelines with nothing left to invest. The hidden math nobody explains. Here's what makes this ratio actually work, beyond just feeling balanced. If your growth layer, the 30%, has a genuinely bad year and drops 40%, you lose 1,200 Indian rupees. Painful, but your total portfolio is still down only 12% overall, because the other 70% wasn't exposed to that same risk. Compare that to putting the full 10,000 Indian rupees into one speculative asset. A 40% drop there means losing 4,000 Indian rupees, completely different emotional and financial impact. This is the actual function of diversification. It's not about maximizing every possible gain. It's about making sure no single bad decision, or single bad month, can meaningfully derail your entire portfolio, which is exactly the kind of loss that causes beginners to panic sell and quit investing altogether. There's a second hidden benefit too. Keeping 20% in cash means you're never in a position where a market crash forces you to make an emotional decision. Investors without a cash buffer often end up selling their best long-term holdings at the worst possible time, simply because they need liquidity and have nowhere else to pull from. HYPE versus reality, THE, go all in, temptation. Social media constantly pushes the opposite of this framework: go all in on one coin, one stock, one big bet, because diversification is boring and slows down your gains. Here's the reality: going all in can absolutely produce bigger short-term wins, in the specific cases where it works out. But for every viral all-in success story, there are far more people who went all in and lost most of their capital. They just don't post about it. A 50-30-20 structure will almost never make you rich overnight. It's also designed specifically so one bad decision doesn't wipe you out either. The irony worth sitting with: the investors who actually build meaningful wealth over time are rarely the ones chasing the single biggest win. They're the ones who stayed in the game long enough for compounding to do the work, and staying in the game requires not blowing up your account in year one. Zooming out, why this matters beyond 10,000 Indian rupees. The real value of starting with a structured, disciplined 10,000 Indian rupees portfolio isn't the 10,000 Indian rupees itself. It's building the habit and the emotional discipline of sticking to a ratio, rebalancing periodically, and not panic reacting to every price swing, habits that matter exponentially more once your portfolio grows to 1 Indian rupee lakh, 10 Indian rupees lakh, or beyond. Most people who fail at investing don't fail because they picked the wrong stock or the wrong coin one time. They fail because they never built a repeatable, disciplined process, and kept making emotional decisions with larger and larger amounts of money as their portfolio grew. Starting small, with the right structure, is how you build that discipline before the stakes get high enough to genuinely hurt. The closing thought. So the next time someone tells you 10,000 Indian rupees is too small to matter, remember this: the goal at this stage was never to get rich off 10,000 Indian rupees. It was to build the exact same disciplined structure you'll need when the number has 3 more zeros behind it. Which leaves behind the real question worth sitting with: if you can't stick to a simple 50-30-20 structure with 10,000 Indian rupees, what makes you confident you'd stick to it with 10 Indian rupees lakh? If this framework helped you see your own portfolio more clearly, subscribe to the Money Mix for more breakdowns just like this one, every week.